ULTY is one of the most popular and fairly new ETFs issued by Yieldmax, and it's definitely been eye-catching, not only because it pays an extremely high distribution yield of 79%, but also because it pays weekly dividends rather than monthly or quarterly. Over the past few months, it's been paying around 8 to 11% per share per week. That means if you had about $10,000 invested in the fund, you'd be earning around $150 per week from its distributions, which is of course very impressive. So let's talk about whether ULTY is truly the ultimate income ETF that could help us easily retire with $100,000 or less. ULTY is similar to other Yieldmax funds in that it generates income by selling a version of covered call options on individual stocks. Then the fund collects those premiums from those options and then pays them out to shareholders, and in this case on a weekly basis. But the main difference is instead of just trading options on one single stock like most Yieldmax funds, ULTY holds synthetic exposure to around 10 to 15 different stocks at any given time. And unlike the regular traditional ETFs, it doesn't actually own the underlying stocks. It instead uses synthetic positions like buying call options or selling puts to replicate the price movement of those stocks without owning them outright. So there's kind of a lot going on under the hood here, but the most important part is that this is an income-focused ETF that's able to pay out so much each week because of all the options activity involved. Now this brings me to the next point, and potentially a red flag when it comes to these weekly distributions. If you go to the Yieldmax website and look at the ULTY ETF page, directly under the distribution rate, you'll see a sentence here that says, the most recent distribution on June 25th, 2025 consisted of 100% return of capital and 0% income, which right off the bat to me kind of raises some eyebrows and sets off a few alarm bells. But before we panic, we need to understand what return of capital actually means. It's one of those things that can mean two different things depending on the context. So return of capital doesn't always mean you're getting your money handed right back to you. In a lot of cases, especially with option-based funds like ULTY, return of capital is really just a tax classification. So the fund might be generating real income from call options and derivatives, but because of how those profits are treated under the tax code, the IRS classifies those distributions as return of capital, even if the fund is still doing well. This way you don't owe taxes on that payout immediately. Instead, your cost basis goes down and then you'll pay taxes eventually when you sell those shares. So in some ways, it's a smart way to defer taxes, especially for income-focused investors. But here's where things can get a little interesting. Sometimes return of capital literally means you're getting your own original investment back. This happens when the fund isn't generating enough income to support its high payouts. So it starts dipping into its NAV, or essentially everyone's capital, to make those payments. So with ULTY, it's really important to watch what the NAV is doing over time. If month after month, the NAV keeps dropping while the fund keeps paying those same high weekly distributions, that could be a sign you're just getting your money handed right back to you. So with that out of the way, let's look at the fund's recent performance. Over the past 12 months, ULTY has a total return, including dividends, of 14.75%, ever so slightly underperforming the S&P 500. But so far this year, it's up 10.4%, again including distributions, which outperforms the S&P 500 by about 3 percentage points year to date. So when you look at total return, even with those huge weekly payouts, ULTY hasn't really kept pace with some of the top Yieldmax ETFs. For example, MSTY is up over 33% year to date, making ULTY's total return look a bit underwhelming in comparison. Now looking at its fees, ULTY carries a slightly higher expense ratio of 1.3%, which is a little bit higher than some other Yieldmax ETFs. And that's likely because there's a lot more complexity and active management involved in juggling multiple options positions. So you're paying a bit more for the fund managers to run this little bit more sophisticated options ETF. So all in all, I think ULTY is kind of an okay fund compared to other Yieldmax ETFs, and it's definitely not one that I would throw my entire portfolio into. But that's of course just my opinion, so let me know what you guys think of ULTY and whether or not you would consider having it in your own portfolio, and I will catch you all next time.